Hello traders, Gary Wagner here, approximately 10 a.m. in Honolulu, 3 o'clock in New York on Friday, the 8th day of June 2012, and this is the daily report for gold and silver, our weekend review. Although gold closed lower on the week, it is having a nice finish as we go into the close today, currently trading up about $5 on the day, $15.95 in terms of the cash price itself. The high today has been $15.9630, low $15.6480, and as I said, up about 0.33% on the day, $5.30 higher. Silver, coming off of the lows, is now trading in positive territory by the slightest of margins, currently trading up about 1 cent on the day. $28.70 is Kitco's price. As you can see on our screen, we are looking at $28.57. We have good strength in the dollar today. That is higher, and we have the stock market also higher. Traders, it is my belief that it's not a matter of if the Federal Reserve and the European central banks will attempt to kickstart their respective economies through monetary stimulus, but when they will do it. A statement made by Ben Bernanke, or I should say a lack of any kind of a statement made, as he reported to Congress this week, sent the precious metals markets into a tizzy and also sent them drastically lower. Traders, we are looking at a 120-minute Heikin Ashi chart. I've scrolled it back in time, and we are looking at this historical record top right around 1920 in the cash market. The reason for looking back this far is that what I want to show us is that this was really that first testing of the 1520 area, tremendous correction in the marketplace as it fell about $400. Now, from there, the market did come off of those lows quite high, and it made its secondary top, this top being around 1820, which brings us closer to where we are currently, because what happened was the market absolutely tested this area again. This is our second testing of the 1520 area, and that still happened last year. Since then, the marketplace managed to come up and form a secondary top. You can see that top right in here as it goes to 1800 again, but basically stall. So we had a defined upper range in the market, and we were also beginning to get a defined lower range, because to say the least, this market has been range bound and not making new highs. Now, as I carry this over a little bit more, you will see where we are currently at, and then we'll go ahead and blow the chart up. But this testing right here of 1800, again, our double top, as we saw this marketplace come down, we had our third test of that 1520 area, in this case, 32 being the low. Week before last, we had the tremendous move up. This is that $60 move up, and it stalled this time at about 1640. And in terms of where that lands historically, I'm going to simply draw a line across, and what we're going to see is that in terms of historical data, there are points in which we can definitely see 1640 acting as either resistance or support. The interesting thing is that there can be no doubt that when this market reached this peak again, it did not have the ability really to take that out. And what we are witnessing right now is the market recouping off of these lows. I truly believe this triple bottom we have witnessed over the last 6 months should hold as absolute support in the market. Traders, I've gone ahead and converted our chart to a 240-minute Heikin Ashi. Each bar represents 4 hours of trading. And what is quite interesting to me, and what I think is most relevant, is when we take a look at this market, and this is longer term, but this is at top at 1800, there can be no doubt that throughout most of this year, this market basically headed in one direction. You had small rallies, but the rallies really were characterized by a series of lower highs and lower lows. That's a market going down. For the first time, and this was about the middle of last month, we actually saw some sort of a bottom forming within that marketplace itself. Now, as it came up, it did find resistance. Our absolute resistance is going to be around 1680. It couldn't make it past 1640. But here's what I'm looking at. For the first time this year, since February, meaning since we had this market have a drastic decline, we've actually got some concrete evidence that the marketplace itself has formed a good level of support, 1532, and my personal sense is, as I said, that should hold. Now, that being said, we still have this critical resistance. We've talked about this all through last week and the week before last, which is this 23% retracement from what I call the big picture, meaning as the market moved back in 2008, trading at about $700 per ounce, goes up to a record high, 1920. And as you can see, when this market came down, we absolutely have a little bit of resistance in that area, right in this 1640 area. At the same time, we can also see this triple bottom that we've been speaking about. My sense is this. As I said, I believe that this bottom is probably going to hold. I also think that this market's going to begin to move higher. We have to see how it reacts at the, 1640 area. Because what is really important right now is being able, on a technical basis, to break through this particular point right in here. Now, of course, we did exit our trade this week. We got long at 1564, I believe. We had our stops, and as this market moved up, we raised our stop to just below 1600. So when the market came down, of course, it knocked us out probably at around 1595, depending on how far below you place that. So in at 64, out at 95, we still were able to pick up roughly a $30 gain on that particular position. Not bad, and we will also look to reposition ourselves from the long side probably the beginning of next week if we continue to see the market forming its base here and having good activity to the upside. Traders, we're looking at a daily chart, Heikin-Ashi format with a couple of Western indicators also. One thing, first of all, relative strength index. As you can see, we have various benchmarks that we look at for oversold and overbought scenarios. The breakout to the upside, it's quite clear, but look at when it hits this upper band right at 70. This is 70 and 30, of course, in terms of the relative strength index. You can see it moving back down, and it hasn't really turned around. Now, our MACD is a little bit different. The MACD did issue that buy signal. As you can see, we got the cross and we got the actual lines moving apart. That's what you look for in the MACD. But you can also see quite easily the little hook. In other words, right in here where this market is starting to hook back, will it cross and move back down, or will it meander and then turn back to the positive side? We'll have to see. And then lastly, in terms of a Western technical indicator, our moving average right now, it's a 14-day moving average, and you can see that we are right at that point just above our 14-day moving average. Of course, traders, the really big story has been the dollar index, and it has been the dollar that has been putting so much pressure on gold. You can see the top here above 83.60, and you can also see on a daily chart, Heikin-Ashi, the market moving back down. However, let's move that to a shorter term chart, and you'll see another piece of the puzzle. Now realize that a Heikin-Ashi is always going to be a lagging indicator. However, when we convert our daily to a 240-minute Heikin-Ashi, what you'll see is that we saw nothing but weakness in the dollar. In other words, we had straight red on our daily. However, on our shorter term charts, you can see that the market did find a bottom and is beginning to move back up. We had this scenario in a couple other places, right in here and right in here, where we had small corrective action in the market before returning to its upside potential. Now, traders, in terms of our trade with silver, we didn't fare as well as we did with gold. We got knocked out at about a break even. Nothing gained really, nothing lost, so to speak. Looking at our 420-minute chart, also in Heikin Ashi format, and this top that it hit at $29.98, call it $30 per ounce, as you can see, fits quite nicely in a Fibonacci retracement that basically covers this range, this sideways action. Of course, we have this top here at around 37. But if we take a look at this series of highs right in here and match it to this low right in here, you can see that we have two areas that we have talked about, the 76 and the 61% retracement levels. Those are two areas which absolutely have given us a little bit of a historical perspective. I'm going to draw a line across, and the first thing we want to look at is 76%. As you can see, as this market comes down, it attempts to find support in this area right here, just at around 2870. You can see this double bottom that we get. Market can't hold it, comes down and tests this low again. The low being around 2660. That's the low right in here. Of course, market came up and it made that secondary top at 37. But since then, just as we saw in gold through the year, the best characterization of this market is that we have had a series of lower lows, as you can see right in here, and also lower highs, as you can see right here. We talked about this a little bit last week, but for the first time, really since February, since this market has been moving down, we saw something that caught our attention because it was a little bit different. As we formed this triple bottom right in here, and when I say triple bottom, I'm talking short term from the middle of May onto current activity, where we had three separate occasions of this market testing the low. But here's what I'm finding interesting. For the first time, we have our lower low here when we compare it all the way down, but when we take a look at the next series of lows, they are higher. And when we take the next series of highs and we compare them, they are also higher. That is indicative of a market that's moving up. It's going to be characterized with higher lows and higher highs, just the opposite of the market going down. So I do believe that once we see this market come back over 2870, I think it's fair to say it will probably make a stab or a testing once again at $30 per ounce. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.